Hey, what's up, guys? My name is Jerry from TraderThings.com, and right now you are tuning in to the Wolf of Forex. Hey, what's up, guys? In today's lesson, we're going to learn about orders, and there's basically two categories of orders. There's like market orders, and then you have limit orders. So the only difference between the two is the time the order is executed, right? So limit orders, they're executed instantly. See, at the best available market price, or like exchange rate. Oh, I spelled that wrong. Right? A limit order is executed at a specified exchange rate, or like price. But there's like four different orders, right? We have a buy order. Oh, that's horrible. All right, so you have a buy order, sell orders. You have a buy limit. Oh, can't write today. You have a sell limit. This is the difference, right, between market orders and limit orders. Basically, a market order is going to be executed instantly at the best available market price, and a limit order is just an order that's also going to be executed at a specified exchange rate. And you can set this to like expire at the end of the day, or whenever you just plan on expiring it, which is like good till canceled. So a buy order and a buy limit order is essentially the same thing. It's just that a buy order is a market order, and a buy limit order is basically executed at a specified exchange rate, right? Same thing goes for a sell limit order, vice versa. A stop order is basically an order that limits your maximum drawdown. You should always place a stop order when you place a buy and sell order. It's just like you have to place them in conjunction. You know, if you're gonna go long, you place a buy order, or if you plan on like setting a buy limit order, whatever your strategy is, you gotta, when you place them, you gotta place the stop order in conjunction, you know. So this basically is like an order that really limits your maximum drawdown. And then you have a trailing stop order, which is essentially a stop order or stop loss order. It's essentially the same thing, except that the order would trail price. You know, if it advances at a certain amount, you can set that. You know, you can set your order to be automated in that way, depending if your platform provides that kind of feature. Or, you know, you can manually adjust your stop loss order as you actively manage your position. So that way, you know, you're reading price action, you know, at the closure of candlesticks, and you're really just making an assessment of, is it breaking the structure, is it rallying, is it trending, and like moving your stops to break even to really keep you in the game. Because if price is gonna run, it's gonna run. If it's choppy, then it's kind of like, okay, you know what, maybe I should stay out. I broke even. So it's like when I walk away with break evens, it's more of like, okay, you know what, my entry is it's a little too ambitious. I need to pull back a little bit. So it's just like I get back in, but I look for going lighter in my position and having a wider stop. So that's just an insight. When it comes to like trailing stops and stop orders, it's just like when you use these orders, you're giving yourself more of an opportunity to make more money. So a trailing stop is basically a stop loss order that also limits your maximum drawdown and also secures profit. As price advances or appreciates or depreciates, whichever direction price will go, using a trailing stop will either break even and get you out of like choppy situations or false breakouts. Also it's all about timing as well. You can't really just jump into the trade and immediately look to move your stop to like a break even. You have to let price develop and then lead and kind of like have its conviction and its movement, and then like adjusting your stops. Most people set and forget. I think that's also a great strategy, whatever works for you. But definitely actively like just managing your position depending on what your strategy is. If you're swinging, scalping, if you're swinging, definitely set forget, and just like watching your position, but also looking for the right time to move your stops when price starts to rally, just so that you can secure profits. It's just a good practice to do, because it's at the end of the day, you're looking to make money. So this is just like what you need to do, the measures that you need to take to make that happen. All right, so when it comes to chart types, there's only really two types that I use, and I'll explain what they are. But the first chart type is a line chart. It's a real simple chart type. It basically just shows you the closing of price, in a real simple fashion. So let's say this exchange rate here, right? Say price is doing something like that. So this is considered a line chart, and let's say this is whatever currency, or say this is a SPY. But this is a line chart. It's a real simple chart. It's basically the closing of price. That's where the line reads. So yeah, real simple. The second chart type is the bar chart. I don't use this one. This basically is like, looks like this. Like this is the high, and you have the low here. Let's say this is the open and the close, and it'll be like green for positive period, red for negative period. You know, that's what that bar chart represent. I'm not familiar with the patterns that it generates, but I know like usually with chart patterns, you can kind of see like consolidation and flags. Once you really start to practice on identifying them. So I'm sure you can identify with the bar chart, but it's just not enough for me. I'm just not really familiar with that. Everyone has their preference. So the third one is Japanese candlesticks. And the candlestick is basically looks like this. It has a body, and then it has wicks. And same thing with the bar chart. If it's green for positive and red for negative, basically negative would mean like it opened here and closed here, and it'll be red, and vice versa for positive. That's just what that means. And the reason why I like Japanese candlesticks is like the patterns are much more easy to identify, and like certain patterns have really generated higher hit rates. So like engulfing patterns, for example, just and also dojis. So it's just they really tell a story, like of what just happened. So that's why it's also important to wait for the closing of price to really make that decision on whatever time frame that you plan on entering on. And we talked a little bit more in detail about that in the candlestick section. But patterns just emerge, like wicks that really show like exhaustion or a reaction to certain levels. So the placement of, or I guess the location of where these candlesticks emerge may like play the real significant role of like identifying the quality of the signal. So we talk a little bit more about that in the later on in this lesson. But that's the reason why I like the candlesticks and the line chart, and using these in combination could really generate like real quality signals. But we talk about that later on. But that's just to take note and look out for. And yeah, so these are the chart types. I know there's other chart types as well. Before I used to be fond of Heiken Raj, but I think that's how it goes. I think that's how you spell it. And it's more smoother version of like the candlesticks, except that it doesn't show dojis as much, and I really like the dojis because if you're a scalper and if you're really that I guess technical or tactical, like you're really precise on your entries, which I mean you could get away with sloppy entries if you go lighter on your position and stuff like that, or if you really know how to manage your position well, then you can get away with that. And if you have a large account, if you're disciplined and you know how to take these protocols and steps, which we talk a little bit more about in this course. But Haken Rosh is definitely just like a smoother version of candlesticks. They just don't show dojis as much as just the regular Japanese candlesticks. I mean, that's just about really all the other chart types. But definitely 1 and 3 are the way to go.